So as you know, COVID over the past 2 years have totally changed the world. It led to a global supply chain glitches, commodity price going sky high, and now added with the Russia-Ukraine war, interest rate hikes, and a slowing global economy. Let's have a pulse check. What's your sentiment towards the overall market right now?
Well, all the problems you mentioned are there. And of course, in China, you've had a crackdown on some of the big companies, which impacted the Chinese market. And by the way, also impacted the emerging markets index, because the Chinese market is a big part of the index. So that sort of turned people off emerging markets to some degree. But then there are other people who are doing active management like we're doing. And we've had a lot in India, Taiwan, and other places. So those markets have done quite well. So it's a very mixed picture, but I would say the global growth picture is not that bad. In fact, if you look at the US, you'll see that the US market is doing very well. The US economy is doing very well. And you see other economies around the world doing fine. And just because there's war in Europe doesn't mean that everything stops. In fact, if you look at some of the defense industries, people that are making military equipment and so forth, they're doing quite well and will continue to do well going forward, because there'll be a lot more military spending coming forward as a result of what's happening in Europe.
So obviously the war has been one of the biggest topics in the world. How do you envision this to play out? Is it going to end soon, or is it going to linger on in the years to come?
I don't think it will end soon, because I don't think the Russians will give in. And of course, the Ukrainians will not give in. And Europe and America are moving to give more and more support to the Ukrainians. And that means that the war will be extended. So I don't see any end within, let's say, a year. I think this will continue.
I know you have a lot of experience in Russia, and you served on the board of previously some Russian companies. Are you is this country totally off your radar right now?
Yes, I was on the board of Lukoil, a big oil company, which is an excellent company, independent of the government. Russia certainly is not off our radar, but we cannot invest in Russia, as you know, because of the sanctions. But once things change, we'll be looking at Russia again. Generally speaking, we've been out of Russia. In fact, our last Russian stock was sold about 8 months ago, simply because we didn't like the corporate governance. We saw that oligarchs were controlling too many of these companies, and we didn't like that picture, so we got out. So it was quite fortunate, actually.
So if the sanctions are lifted, and if this time around all the oligarchs are out, you will eventually go back in. And if you do go back in, is there any particular sector that may interest you?
Yes, of course, anything to do with technology is of great interest. As you know, the Russians are great software engineers. They're doing a lot of work in technology. So that would be one area that would be of interest to us. And also consumer products. It's a big consumer market, and that would be another area.
But what about investors' view? Obviously, we run other people's money, and some people say, okay, investing in Russia could be profitable. Doing the right thing could be another matter. How do we juggle between this nowadays as a fund manager?
Well, you know, now the words are ESG, and we've added C, ESG plus C. In other words, environmental, social, governance, and culture. We are evaluating all the companies in which we invest on those factors. And the reason why we do that is because it's a way to reduce risk. If you have companies that are not complying with environmental standards, if they are not a good social partner, if they are not having good corporate governance, and most of all, if the culture within the company is not good, then you know you're going to be in trouble. So these are ways that we have to reduce risk, and it has nothing to do with, you know, doing good for the world or anything like that. It's a way to invest more profitably.
Right. How does inflation kick in? Because global supply chain is having a lot of disruption. Material prices are increasing. Do you see that as an ongoing concern?
Of course, well, you're going to see an increase in prices simply because the currencies have been devalued as a result of the increase in money supply. If you take the US, for example, last year money supply increased by over 30%. So when you have that kind of increase in money supply, you can expect a increase in inflation by at least that much, 30%. The good news, as I point out in my book, is technology is driving down prices. Well, so while you're having a devaluation of currency and therefore rising prices, you're having technology come in to drive prices down. And that's what we're seeing now.
Yeah, this leads to a very interesting topic because recently you say that rising interest rates actually do not affect equities in general, and you even talk about it in your latest book. Do you fear rising interest rate? And if you don't, can you tell us more about your thesis?
Yeah, I mean, you've seen rising interest rates throughout the world in various periods of mankind's history, at least in the history of the stock markets. And if you draw a line of interest rates and a line showing, let's say, the S&P 500, there's really no correlation. In other words, higher interest rates, of course, affects the fixed income market, the bond market, but not equity markets. And the reason for that is that there's so many companies that have pricing power. In other words, as prices rise, they increase their prices for their products in general. So if you're importing, for example, some kind of raw material, whether it be nickel, palladium, platinum, whatever, and you're producing goods of those raw materials, the raw material prices are going up, but you are also increasing your prices. And of course, the other side of the coin is that you're paying your workers more. So your workers are able to buy with the higher prices. Again, as I pointed out in my book, if you look at the history, you'll see that rising incomes, like what we're seeing now in America, rising salaries, keep pace with the rise and prices in general and the devaluation of currencies.
So which countries do you think will benefit the most from what you just mentioned?
Currently, of course, the US is going to do quite well, but every country has companies that are able to achieve this pricing power. And that's the reason why we have investments in Brazil, in South Africa, in Kenya, in Turkey, in India, of course, Taiwan, Korea, Vietnam, and so forth. Because you have, anywhere you go, you can find companies that have this ability.
In your recent interview, you mentioned that you have been switching your focus out from China and into India. Could you tell us more about why you decided to do that?
Well, it's really a matter of companies. We found more companies in India in the middle and smaller category, in the companies in which we like to invest. We found more of them in India than in China. But that doesn't rule out China. We still are looking closely at Chinese opportunities.
And in India, what about currency risk? Because as an investor myself, the only thing that I can't control is the currency issue. Whereas I think China may have a relatively more stable renminbi. So in India, how do you hedge your risk there, or you just focus on US dollar type Indian companies, with export and all that?
Well, if you look at the Indian rupee, actually, it's been relatively stable. It hasn't been very volatile. But what we do is we look at the company. In other words, we try not to hedge currencies for a number of reasons. One, it's very expensive to do if you're a long-term investor, and it often doesn't work. So what we do is look at the company to see what their earnings are in US dollar terms. It doesn't mean that they're exporters or anything like that, but their ability to have a good profit margin will mean that they are earning very well in US dollar terms.
What about the political risk in India? Obviously, on paper, it has great prospects, but the politics there have also driven up volatility. I mean, maybe we don't see that as much in the news because, maybe the focus is now in Russia or China, but I guess in India in itself, it's also have great politics going on, right?
Actually, India, being a democracy, will evidence a lot of turmoil. It will look like there's a lot of conflict and so forth because there's a free press. This is something you will not find in China. But the reality, as a democracy, it's relatively stable because you must remember there are a number of states in India. In fact, I like to call India the United States of India because there are a number of different states, different languages, different ways of doing things. And that creates a big mix, similar to the US, by the way. In the US, you'll find very big differences between the states. And that ends up to be relatively stable because all of the protests, all of the disagreements come out into the open and they're able to work it out in a democratic form. So we find that India is relatively stable.
I see. So what about China as a comparison? What do you think of China right now?
Well, right now, I think the government has done a fairly good job in trying to create a level playing field. They may have gone a little bit too far with some of the big companies, but that's okay if they're able to achieve that level playing field so that the small and medium-sized companies can operate profitably and do well. That I think is a good move. The other thing the Chinese government is doing, of course, is lowering interest rates. In other words, they're going in the opposite direction as what the US is doing. And as you know, words from the government have a lot of meaning for the stock market. And recently, high government officials in China have said that they think the market should be higher. And that's probably the reason why you've seen a bump up in the index for China.
Right. So you mentioned that you do look at China, and is there any particular sector that interests you within China?
Yeah, anything to do with healthcare to begin with, not necessarily COVID related, but anything that is involved with beauty, healthcare, enhancement of the health of people, that sort of thing. That's a very big interest to us. And of course, technology, whether it be software technology or hardware technology.
So let's switch topic a little bit to talk about some real investments that you have been making and what you have been doing since you left Templeton. You started Mobius Capital a few years ago, and you take an active ownership approach to investing in emerging markets. Can you tell me more about why you started this framework and tell me more about what it is and what it means?
Well, as you know, when you're running something like $50 billion, like I was at Franklin Templeton, it's very difficult to be too far from the index. So there's a tendency, if you're running $1 billion fund, to have a portfolio that looks like the index, because you're focused on the big companies, of course, the companies that have a heavier weighting in the index. So we felt that it was time to get away from this kind of mentality and to start something smaller, something that is not related to the index at all. In fact, there are only 1 or 2 stocks in our portfolio that are in the index. That's one thing. The other thing is to focus on companies that have been overlooked. As I said, if you're running billions of dollars, you don't want to fool around with small companies. You have to deal with large companies. So a lot of the medium and small cap companies are overlooked. So we decided that that's where we want to find opportunities, because if people are overlooking this, there may be some very, very good opportunities. And of course, it's worked out very well. Last year, our fund was the best performing of all the emerging market funds around the world. Hopefully we can continue this track record, no guarantee, but generally speaking, what we're doing is focusing on medium and small size companies, non-index companies, and of course, focusing on ESG plus C. So when we sit down with a company, we want to ensure that they will be willing to work with us in improving these characteristics.
Can you share some examples and to how your approach helped these companies to create or unlock value?
Yeah, a good example is a company in India, a company that is an industrial company. And what we did is sat down with them and said, look, we notice on your board of directors, there's no woman. And there's only one independent director. We advise you that you should try to get a woman on the board and also another independent director. And maybe you can kill two birds with one stone by doing that. And they complied to that. They were willing to go along with that idea. And the market perception has improved as a result of that. It's really helped. So there are many examples like that where we go into a company and we advise them in a nice way, in a cooperative way. We don't try to be aggressive in any way. And very often the stock price will improve as a result of that.
Do you face a lot of pushbacks as well? Obviously, there are companies that are willing to work together with you, but I suppose in a lot of emerging markets, a lot of these companies don't have the right standard and they are just unwilling to comply with your suggestions. What are some pushbacks and challenges have you faced?
Well, first of all, we will not work with a company that's not willing to work with us. So we will not invest in such companies. But the biggest barrier we found was family-owned companies where the family members are not willing to bring in outsiders into the board or into the management. That's a big, big challenge. But again, as I said, we found a number of companies that were willing to work with us in that regard. And some of these family companies are wonderful companies. Once they get some independent directors and independent views, things improve dramatically.
How do you usually motivate these family companies to change? Obviously, it doesn't just run with one chairman. Sometimes it's the entire family or generational kind of issues. How do you motivate them?
The best motivation is money. And the way you do that is say, look, you want to see a better share price because they are all shareholders in the company. And of course, they universally want to see a better share price. And that's what we tell them. If you want to get a better share price, which will mean money in your pocket, then you got to work with us.
Do you usually work out a pipe deal or you just buy in the open market? Or some of these are private companies?
No, we only deal with listed companies, companies that have a reasonably good turnover because we're running open-ended funds. So we've got to have liquidity, usually about $1 million a day turnover. So, we need that kind of liquidity. But otherwise, we're, of course, open to IPOs. We're open to new ideas. But generally speaking, it's not very attractive. And we're finding enough good opportunities in the listed sphere that we don't have to go further afield.
But what about for the risk-averse investors who just want to do something simple? In this great uncertainty, besides investing in emerging and frontier markets, let's just say, let's do something simple. Where are you going to allocate your money if you just want to be risk-averse, make it simple? Is there any place that you will look at right now?
Well, the bottom line is that, one, you've got to be diversified. You cannot put all your eggs in one basket. So people who are just concentrating on Europe are in trouble now because Europe is in trouble, generally speaking. So that's number one. Number two, you've got to be in equities. With inflation coming, with higher prices, you've got to be in companies that have pricing power. That means being in equities, not fixed income. And the third thing is, as I said, it's not simple. You've got to go out and kick the tires or hire people who are doing that with their funds.
In your previous interviews, you mentioned that it's not a bad idea to have some gold. Do you still prescribe to this idea?
Yes, of course. Just think about the people in Ukraine. You're in a home that has been completely bombed. The Russians are coming. You cannot take anything with you except some gold. And that could be a lifesaver.
As I think about the world, I certainly don't feel that we are in the beginning of a bull market. You know, since the financial crisis in 2008, we've had a very strong bull market in history. Do you foresee a big crisis coming? Or do you think the COVID issue, the COVID situation reset the world and we are now in the beginning of a new economic boom?
There will always be crises. We will never escape some kind of crisis. That's the nature of humankind. But the bottom line is that if you look at the equity markets, of course, there are corrections along the way, but it's always going to be upwards trajectory for the reasons I mentioned. These companies have pricing power and the stock market goes up. So when there is a bear market, when there's a big downturn, it's really a wonderful opportunity.
Right. And obviously geopolitics has been playing a big part with the US and China now trying to compete in all sorts of aspects. How do you anticipate this conflict will eventually affect the entire capital market?
Well, the good news is that the competition is resulting in more and more technology improvements. And the competition is also going to urge the companies and countries to do better, to improve. So I would say it's a good thing, as long as it doesn't turn into a hot war and remains a cold war.
A closing question for you. What is your hope for the world going forward from this dark place we feel today?
I'm very optimistic. I think we're in the most glorious period of mankind's history. Technology has made things so much better, so much cheaper. The fact that we can have this conversation today, 10, 15, 20 years ago would have cost, well, it wouldn't have been possible because we wouldn't have had the technology. So we're now really in an incredible period of mankind's history.
Well, Dr. Mobius, you are so right, because I remember 12 years ago when I tried to interview you for my book. It took me so long to grab a hold of you. And now we could do it through Zoom, and the world has certainly changed. And if you do come by to Hong Kong, feel free to let me know, and I would love to see you again in person. And in the meantime, stay safe, and thank you so much for participating in this interview today.
Thank you. It's a pleasure.